When I invested my first $1,000, I did not start by looking for the hottest stock or the most exciting trend. I started by asking a simple question: what is this money supposed to do for me? Most beginners rush into investing because they want fast growth, but without clarity, even a good investment feels stressful. I decided that my first $1,000 was not about getting rich quickly. It was about building confidence, learning how markets work, and creating a foundation for long-term wealth. That shift in mindset changed everything. Instead of gambling, I was building a system. I also made sure I had a small emergency cushion in place before investing. If your last dollar is in the market, every market drop feels like a crisis. Investing should feel disciplined, not desperate. I committed to thinking like a long-term owner, not a short-term trader. That meant focusing on consistency, patience, and realistic expectations. My goal was steady growth over years, not dramatic gains in weeks. If you treat your first $1,000 as training capital, you remove pressure and gain clarity. That clarity allows you to make calm, rational decisions instead of emotional ones. Splitting the money into clear buckets. I did not put the entire $1,000 into a single stock. Instead, I divided it into simple buckets to reduce risk and create balance. First, I allocated a portion into a broad market exchange-traded fund that tracks the overall stock market. This gave me exposure to hundreds of companies at once, which immediately reduced the risk of one company hurting my entire investment. Next, I placed a smaller portion into a high-quality dividend-paying company with a strong track record. The purpose here was to start understanding how ownership in a business can generate income over time. Finally, I kept a small portion in cash inside my brokerage account. This was not wasted money. It gave me flexibility and allowed me to buy more if prices dipped. By spreading my first $1,000 across these buckets, I built diversification from day one. I did not try to outsmart the market. I focused on simplicity and risk control. Many beginners think diversification requires a huge portfolio, but even with $1,000, you can structure your investment thoughtfully. The key is intentional allocation, not random decisions. To make that allocation even stronger, I also thought about time horizon and risk tolerance before finalizing the split. If I needed the money within a short period, the strategy would have been different. Because this was long-term capital, I was comfortable with market exposure. I also made sure the exchange-traded fund covered multiple sectors such as technology, healthcare, consumer goods, and industrial companies. That way, I was not betting on one industry. I reviewed the historical performance not to predict the future, but to understand how the fund behaved during downturns. Volatility is easier to handle when you expect it. For the individual dividend company, I looked at consistent earnings, manageable debt levels, and a history of paying and growing dividends. I avoided companies that looked cheap but had unstable fundamentals. The goal was stability and learning, not speculation. By adding this layer of analysis, my first $1,000 was invested with intention, structure, and risk awareness rather than impulse. Choosing low cost and long-term over excitement. When I selected my investments, I paid close attention to costs. Expense ratios, trading fees, and unnecessary charges quietly eat into returns. Over many years, small fees compound just like gains do. That is why I chose low-cost index funds and avoided frequent trading. I also ignored hype. There will always be a trending stock, a viral investment idea, or someone claiming easy profits. For my first $1,000, I avoided speculation. I focused on assets with long-term growth history and solid fundamentals. I also set a rule for myself. I would not check my account every day. Constant monitoring leads to emotional reactions. Instead, I reviewed my investments periodically and stayed focused on the bigger picture. Investing is not entertainment. It is a strategy. By choosing low-cost, diversified, long-term assets, I allowed compounding to do its work quietly. The goal was not to feel busy. The goal was to own productive assets and let time work in my favor. That discipline protected me from common beginner mistakes like panic selling or chasing quick gains, automating the habit after the first step. The most important thing about investing my first $1,000 was not the allocation itself, it was the habit it created. After that first investment, I set up automatic contributions from my checking account into my investment account. Even small amounts added consistently make a powerful difference over time. Investing once builds awareness. Investing regularly builds wealth. I treated investing like a fixed bill that I pay to my future self. By automating contributions, I removed the need for motivation. The system handled it. I also reinvested any dividends instead of withdrawing them. That allowed compounding to accelerate naturally. Over time, the portfolio grew not just from market returns, but from consistent additions. This is where most beginners fall short. They invest one time and stop. Real progress comes from repetition. Your first $1,000 is important, but what truly changes your financial life is the decision to keep going. Consistency turns a small start into meaningful growth over years. Managing risk and expectations. Finally, I accepted that markets move up and down. After investing my first $1,000, there were days when the value dropped. Instead of panicking, I reminded myself that volatility is normal. I had diversified, chosen quality assets, and committed to long-term ownership. Temporary declines did not change the long-term thesis. I also kept learning. I read about asset allocation, risk tolerance, and tax efficiency. If you are in the United States, understanding retirement accounts like a Roth individual retirement account or traditional individual retirement account can significantly improve long-term outcomes. Taxes matter. Structure matters. Patience matters. Investing is not about perfection. It is about discipline and continuous improvement. That first $1,000 was not life-changing on its own, but it changed how I think. It transformed me from someone who saves into someone who invests intentionally. And that identity shift is powerful. If you approach your first $1,000 with clarity, diversification, low costs, automation, and patience, you are not just investing money. You are building the foundation for financial independence.